Hello, my name is Jason Mercer, the Toronto Real Estate Board's Director of Market Analysis. I'm going to take the next few minutes to go through an updated outlook for the residential real estate market in the TREB market area, which is made up of the City of Toronto, the surrounding 905 area code regions, South Simcoe County, and the town of Orangeville. Before we get into the outlook, however, let's take a look at a few highlights from 2014. There were 92,867 sales reported through the Toronto MLS system in calendar year 2014, and this result represented a 6.7% increase over calendar year 2013 and was the second best year on record behind 2007, when sales spiked in the second half of that year due to the impending City of Toronto land transfer tax. Now, the average selling price for 2014 transactions was $566,726, which was up by 8.4% compared to calendar year 2013. It likely comes as no surprise that last year's strong price growth was driven by the low-rise side of the market, as sellers' market conditions prevailed for single and semi-detached houses and townhomes in many neighborhoods within the TREB market area. So that's 2014 in a nutshell. Now let's turn to see what we expect for 2015. Now, any outlook on the housing market involves analyzing the tug of war between potential drivers of and drags on housing demand. First and foremost, over the last few months, has been the price of oil. Since August 2014, the price of oil has been dropping quite steadily. The price of West Texas Intermediate crude has dropped to levels not seen since 2008 and 2009 during the recession. Now, the reasons for the price drop have been somewhat geopolitical, as Gulf producers, including Saudi Arabia, have refused to cut production in order to retain market share in the face of shale oil and oil sands producers. The result has been a high level of supply relative to demand and dropping prices. Now, lower oil prices have obviously been concerning from the perspective of the overall economy in Canada, the potential for job losses, and the negative income effect associated with the decline in equities markets. All of this could eventually feed through into a dip in consumer confidence, which obviously could impact big-ticket purchases, including houses. Now, while the dip in oil prices could have a negative impact on consumer confidence, another argument is that outside of the western provinces in Canada, we could actually see some positive effects. From the perspective of consumers' pocketbooks, they're spending less on gas, and so they have more to spend on other things. On top of this, thinking about the GTA and other southern Ontario jurisdictions, the decline in oil prices has also been matched by a drop in the value of the Canadian dollar vis-a-vis the US. This is a good thing for companies in Southern Ontario producing goods and/or services for export abroad, as well as industries like tourism. More US and other foreign currencies purchasing goods and services in Southern Ontario could feed through into more jobs, more business investment, and stronger consumer confidence. Now, at the beginning of 2015, these were the key economic issues requiring consideration when thinking about the direction of home sales in the GTA. But of course, the Bank of Canada changed things dramatically on January 21st, when they announced an unexpected cut to the bank's target for the overnight lending rate from 1% to 0.75%. The renewed monetary stimulus was designed to further enhance demand for exports as the value of the Canadian dollar receded, and to see an increase or at least backstop current levels of consumer spending. This is certainly the case if we think about affordability in the housing market, which we define by the share of the average gross household income dedicated to mortgage principal and interest, property taxes, and utilities associated with the purchase and upkeep of an average price home in the GTA. TREB's affordability calculations further are based on a 20% down payment and a 5-year fixed rate mortgage. This is important because the 5-year rate is based upon the yield for the 5-year Government of Canada bond, which had already been trending lower ahead of the bank's rate cut and dropped dramatically afterwards. So assuming lower borrowing costs in 2015 compared to 2014, TREB's affordability indicator is expected to remain somewhat flat over the next year. And I'm tipping my hand a bit here, but that's with a relatively strong increase in the overall average selling price this year as well. So with all this in mind, TREB continues to forecast an annual increase in sales this year. Our point forecast is for 95,000 transactions to be reported through the Toronto MLS system. So this means that the expectation is for lower rates and an uptick in economic activity in Southern Ontario to trump the negative impact of falling oil prices and the potential dip in consumer confidence. Now, every forecast has an upside and a downside risk. Obviously, the downside risk is associated with a broader base economic slowdown in the Canadian economy that hit Southern Ontario market harder than expected. The upside risk is mainly associated with the supply of homes for sale. The constrained supply of low-rise homes in the GTA is expected to remain more or less in place. However, it is possible that last year's strong price growth and the recent rate reduction could prompt more people than anticipated to list their homes for sale this year. If this were the case, we would likely alleviate more of the pent-up demand than has built up in the marketplace over the last 2 years. And this could push sales closer to the 100,000 mark. Now, having just had this discussion regarding sales and listings, it's easy to segue into the question of price. So as discussed, market conditions have been quite tight over the past year, as evidenced by record and near record lows for low-rise months of inventory over the last year and a declining trend for condo apartment inventories as well, despite record completions of new units over the last year. Even with a moderate uptick in listings this year, market conditions will remain tight enough to prompt upward pressure on the average selling price, well above the rate of inflation. The average selling price for all home types will increase approximately 6% this year to just over $600,000. Price growth will continue to be driven by the sale of singles, semis, and townhomes, but market conditions for condominium apartments will also remain balanced and at the same time slightly tighter than what was experienced in 2014 because high-rise project completions, as reported by RealNet Canada, are anticipated to be lower than 2014's record level. Average price growth with this in mind for condominium apartments will likely be in the mid-single digits more often than not over the next 12 months. So this completes the market outlook for this quarter. There's no doubt that we will experience some interesting events over the next few months as we come to terms with changing economic conditions. I look forward to speaking with you again in the spring. Thank you very much.
Brought to you by GTA Realtors.